Hello, I'm James Yardley, and today I'm joined by Fiona Harris, investment specialist on the JPM US Equity Income Fund. Fiona, thank you very much for joining us today.
Oh, delighted to be asked and delighted to spend some time with you.
Now, Fiona, the US stock market it's not really known for its dividend. In fact, I think your fund yields about 2%. Why is the yield lower in the US, and why should investors still consider investing in a US equity income fund?
You know, that's a great question. And you're absolutely right. I think the long-term yield on the S&P 500, if we use that as a proxy for the overall US market, is about 2%. And it's always been lower than the UK market. Now, it's not that the US hasn't had a history of paying dividends. I think we've all heard of the Dividend Aristocrats, those companies that have consistently paid a dividend for 25 years or more. It's just, what do you use your excess cash for? As an individual, as a company? And when you think of it as a company, there's lots of things you can use that cash for. Some of it can be given in dividends. Some of it can be given in buybacks. So you buy back your shares, reduce the number of shares outstanding, your earnings per share increases. Some of it is used to pay down debt, which we'd all think is a great thing to do. Some of it is used to invest in the business itself, maybe make an acquisition. And then some of it is, again, just capital allocation, I think is what we're thinking about here. Some of it is used for maybe capital expenditures, buying equipment, increasing productivity. So US, I think companies are in great financial shape. They've got an awful lot of cash. They've just got a lot of uses for it. And they make good use of that cash. So if you think about the US stock market, over the last 3 years, 5 years, it's up double digits on an annualized basis. And those returns have been delivered because of those investments from companies. So I think that's really important. You've had good returns from the US market because companies have invested wisely. And so it's not always in the shape of giving you and I a dividend. But the other thing to think about in regards to dividends in the US is why it may be a lot less than the UK market. It's very diversified. If we look again at the S&P 500, you've got 11 major sectors. 6 of those 11 sectors yield 2% or more. And every sector has a dividend. So I think there is a history of dividends. We just don't get it to the same level. And even within the S&P, about 79% of the S&P companies pay a dividend. And about 250 companies have increased their dividend this year. So I think, yes, there is a history of dividends in the US marketplace, but it's not just the only source of cash. I think that's really important. And at the end of the day, by having that balance of dividend investing versus investing in the company itself or doing buybacks or doing acquisitions means that you get a better return, hopefully, from the stock market, not just one driven by dividends alone.
So Fiona, you mentioned the Dividend Aristocrats then. Are these the sort of stocks which you're looking for in the fund, those companies which can pay these dividends and grow those dividends for years and years, like Johnson & Johnson? Is that a company you like, for example, and are there other examples?
Yeah, you know, I think the Dividend Aristocrats are really a good indication that the US market is a dividend market, but it's not something we feature in our portfolio. It's not a rationale for investing in a stock. Our process is very simple. We want to invest in quality companies that are attractively priced, that pay a dividend of 2% or more. And dividends come last for us. Quality has to come first. So a company with a good management team, a really strong competitive advantage, good balance sheet, consistency of earnings. And if we get those companies at an attractive price that have an ability and an intent to pay a dividend, we should be rewarded long term. But you're right, Johnson & Johnson has been a holding in our portfolio for a number of years. And when we say long-term dividend payer, I think it's about 50 years or more that they've actually been paying the dividends. And they're not the only company. We've got companies like Coca-Cola. But that's not the reason we hold them. We have to have that quality aspect, that good management team, that good balance sheet, an attractive valuation. And I think if we think about healthcare in general, which is where Johnson & Johnson sits, It's been a sector that's been very much under pressure for the last few years in the US market. There's been talk about regulation. There's been, of course, if you haven't had a COVID drug, you've been left behind. And so the sector actually started trading at very attractive multiples over the last 2 years. And when you've got an attractive business, an attractive valuation with a good dividend yield, that's our wheelhouse. That's what we're looking for. And Johnson & Johnson definitely hits that spectrum. And so when we look at the quality of the business, their pipeline, their balance sheet strength, and we get the yield of 2.6%, it makes a compelling valuation as well. It makes it a compelling offering to have included in the portfolio. So, that's why we like the company. It's the fundamentals. It's not because it's had a history of paying the dividend. And I think that's really important, because what we recognize is that in times of crisis or stress, if you've got a good balance sheet, you can weather those challenges, including sustaining your dividend over those periods, but also that you'll get a better return from these companies as well.
And happily, the fund has performed very well year to date. I think you're about 7% ahead of the S&P when I last looked. Why is that?
Yeah, and I mean, it's a great place to be, particularly when the marketplace is in such a negative turmoil at this moment in time, to deliver positive return for clients. We look at the process that we employ, as we talked about. It's very simple. It's looking at the fundamentals, those quality companies that are attractively valued, that pay dividend. Now, irrespective of what comes in or out of favor in the markets, they're the characteristics of our investments. And it's time tested. It's the same process has been in place since we launched the fund in 2008 and when we launched the strategy 2 decades ago. So whether the market likes value stocks, small cap stocks, large cap stocks, mid cap stocks, growth stocks, tech stocks, it doesn't matter to us. It's the same process we employ. And by focusing on those quality companies with good balance sheets, good characteristics, they typically do well in periods of turmoil in the market. And that's what we're seeing right now. Those companies are really executing so well. The market is recognizing that leadership when it has so many other concerns and so many other risks at its helm. And it's amazing how quickly the market turns. If we looked at this portfolio a year ago versus the S&P 500, it wouldn't have looked half as attractive in terms of returns. But again, sticking to your process, recognizing that it will come around at some stage in terms of the market, it's very rewarding when you hit those periods.
And what is your view on the outlook for the US economy and the US stock market for the rest of this year and for 2023?
I suppose that's the question that the market's been trying to answer all year. It started in a nice return fashion in January, and we saw financials do well and the prospects of interest rates rising. And then inflation fears gave way to recessionary fears. I think the market now recognizes that inflation may have peaked, but it's peaked at a lot higher rate than many expected. And the Fed has been a lot more aggressive on raising rates than we would have anticipated at the start of the year. But what we do know is the economy this year is growing, but it's growing much slower than it did last year. We also know earnings are growing, but they're much lower than they were last year. And the market is trying to absorb this information and trying to figure out, do we go into recession in the next 12 months or don't we? And frankly, it's probably a coin toss. It's probably 50-50 whether we have a recession or we don't. But at the end of the day, what we do recognize is we are having an economy that is slowing in terms of its growth. And that's really important, because at the end of the day, what happens in the economy comes true in terms of corporate earnings. And so what we can recognize is that earnings are still growing, and we expect them to grow this year and next year. The multiple of the market has got cheaper, not because the price has gone down, but actually we've had earnings growth, had positive earnings growth for US companies. So if we have that economic slowdown, even if we have that recession, our thought process is it won't be a prolonged one. It doesn't feel like there's excesses in this economy right now, or this market, where we'd have a very much a prolonged one like we had, like the global financial crisis. We're not going back there. There's no housing bubble. I would say there's no tech bubble. There doesn't feel like there's a bubble in the US economy anyplace. So we may have that recession, we may just have an economic slowdown, but the earnings are still good. And I think that's really important when we're looking at the companies in the portfolio, that we've got those names within it. And I would say normally when the market sells off, we're full of activity, we're full of adding names to the portfolio. Right now, we're not doing a huge amount in terms of adding new names because we're looking at that earnings, and that's really important. You have to have conviction in the earnings for the next 12 to 24 months to want to step into some of these names. So some of the names that are most beaten up, we don't have that real strong conviction that earnings are going to be good over the next 12 to 24 months. We think some of these companies will struggle over those time periods. So we're not buying really the whole market in terms of what's the cheapest out there. We want the highest quality. And we feel right now we've got those names within the portfolio. So whatever happens to the economy, our names should be able to navigate it well.
Fiona, that's been very interesting. Thank you very much for sharing your thoughts today.
My pleasure.
And if you'd like to learn more about the fund, please visit chelseafs.co.uk.